Class, welcome to week 5 and getting to capital gains and losses. This chapter gets pretty nuanced. There's a lot of rules to capital gains and losses, depending if something, is personal use, business use, holding periods. There's a lot that can go into it. So there's probably going to be 4 videos this week and probably a little bit longer in nature. So just want to give you that heads up. So with that being said, let's get into it. So chapter 5, learning objectives. Determine realized gain loss from sale disposition of property, determine the basis of property, understand how capital gains are taxed for non-corporate taxpayers, determine the holding period for an asset, describe tax planning for gift property transactions, describe compliance and procedural considerations for property transactions. Here we got an example, and I'm going to walk you through it, but let's get into it. Assume you currently own a Mastercraft wakeboarding boat. You bought it 8 years ago for a $40,000 price, had to pay sales tax of $2,400. You no longer are into wakeboarding and have paid $100 to advertise that it is for sale for $30,000. The buyer comes to you with the offer to trade his fishing boat with a fair market value of $10,000, snowmobile with a fair market value of $5,000, and side by side with a fair market value of $6,000 and $9,000 cash. You decide to accept the deal. What tax questions come in? So in this, what you're really looking for is what is your basis in this wakeboarding boat? You bought it for $40,000. You had to pay sales tax of $2,400. Your basis in this is $42,400. Sales tax gets added on to the price for capital gains and losses because it's part of the purchase price, right? I bought this for $40,000, but I also had to pay $2,400 to acquire it. So it's $42,400. You're no longer into wakeboarding and have paid $100 to advertise that it's for sale for $30,000. So your basis is $42,400. You're selling it at a loss, and you paid $100 to advertise it. Generally, the cost of sales gets factored into the realized gain or loss. So you have this $100 deduction for that. So your basis is now, so if we were looking at it from here, you would have a loss of 12,400. And then that would go to 12,300 with the extra $100. The buyer, so he's got 10,000, 5,000, we've got 15, we've got 21,000, 30,000 for everything altogether. Because this is a personal use item, losses are not deductible. So yeah, we sold this at a loss, but we don't get to claim that loss. I'm assuming, I guess, based on this, that it's a personal use item. We're not using this wakeboarding boat for a business. That's another one of the questions that comes to mind that I just kind of assume, but here we're saying it's for personal use, sold at a loss. You don't recognize loss on personal items for capital gains. Property transactions. Generally, sale or exchange of capital assets will result in recognized capital gain or loss. Then the transaction will be categorized as short-term or long-term, depending on how long the taxpayer sold the property. Short-term is less than or equal to 1 year, long-term is greater than 1 year. And this really just kind of gets into the realized gain, right? Sale or exchange, fair, it's realized value. Here we've just got some acronyms: short-term capital gains, short-term capital loss, same for long-term. How these net out. Taxpayer will combine short-term gains and losses and long-term gains and losses. Net long-term gain or loss and net short-term gain or loss are combined to derive an overall short-term. So if I sold one item for a gain of 10,000, I sold another one for a loss of 5,000, that's a loss of 5,000. If I had the gain of 10, the loss of 5, they get net. Long-term capital gains are taxed at a favorable rate, and long-term capital losses are limited to $3,000 deduction. So in that case, I sold this long-term capital item at a gain of 10,000. I sold another one at a loss of 5. So nets out to 5. I can only claim 3,000 per year, so that 2,000 gets carried forward to next year. Capital gains and losses have been given favored tax treatment since 1922, and long-term gains for individuals are taxed at lower rates than ordinary income. And we'll get into what those rates are, but it's at most it's going to be 20%, whereas tax brackets go as high as 37% in this. That obviously is subject to change, but capital gains have historically been taxed at a favorable. Calculating the realized gain or loss. So that's going to be your amount realized less your adjusted basis. And this is broken down to its absolute simplest components. It can get pretty complex pretty quickly, but this is what it boils down to. So calculating adjusted basis, it's your initial basis plus capital addition. So think I bought a house for $100,000. That 100,000 is my initial basis. I had to replace a roof and I added a porch, and together those were $50,000 altogether. So my new basis is $150,000. The 100,000 originally, plus my capital improvements additions of 50, less capital recoveries. That's generally going to be depreciation. You get into some stuff with items that were destroyed, that gets factored into it. But typically it's going to be depreciation. So if I have the same business, so here's my $150,000, but I've got this $20,000 deduction for depreciation. My new adjusted basis is $130,000. I'm not going to go through this entire slide. Probably be worthwhile to print it off, but it kind of goes into, is this a gift? Is this a bequest? Is it long-term? So why the lower tax rates on long-term capital gains? Got a YouTube video here you can look at, but really it's the decision of the government. It's more willingness to buy and sell. It lowers the cost of capital and spurs investment, and it mitigates the effects of inflation. People now have a benefit of hanging on to assets for longer than you do, right? It's helpful for the economy is what it really boils down to. So what are capital assets? Here we've got a following of what aren't capital assets. Inventory or supplies, obviously that's inventory. Depreciable business property, real or personal. Land used in business, accounts receivable or notes receivable. Certain properties created by efforts of taxpayer, think of like intangible. And copyrights also. Section 1231 property. The sale of either section 1221 or 1231 property could create capital gain or loss. Sold, the property is not a capital asset, and gain or loss is ordinary, right? If it's not capital gain or loss in nature, it's got to be ordinary. Section 1231 property includes trade or business property that is subject to depreciation and real property used in trade or business. So what are capital assets? Assets held for personal use, tangible or investment. Stocks and bonds, cars, houses, boats, rare collectibles, things that, assets that you hold. Capital assets held for personal use, kind of what we went over on the beginning example, but your gains are taxable. Gain on the sale of a car. I bought my car for $5,000. Somebody really wants it for whatever reason, even though I've driven it, and are willing to pay $10,000. I recognize a $5,000 gain. Flip side, losses are not deductible. I've got that same $5,000 vehicle and I sell it for $2,000. I don't get to claim that $3,000 loss. It's gone. I don't get to claim it because it's a personally held item that I sold at a loss. Capital assets held for investment. Works exactly like how you think it would. Capital gains are taxable, capital losses are deductible. I buy Microsoft stock for $10,000 and I end up selling it. It's not doing well. I'm worried about it. I sell it at a loss of 5,000. I get to claim that $3,000 loss. I'm not holding this for personal use. I hope it makes money, but I can't personally use this stuff. So I would claim the $3,000 loss in current year, and then next year, that 2,000 would carry forward. Here we've got some terminology, fair market value, property price that would change hands between willing buyer and willing seller. There's no gun in anybody's head. I want something, you want to sell something, we agree on a price, that's the fair market value. Amount realized, what the seller receives for his or her property. Let's go back to the Microsoft stuff. I bought it for $10,000 and I sold it for, in this example, 20,000. My amount realized is 20,000. So amount realized doesn't really take into consideration basis. Adjusted basis, what the property had cost the seller while they owned it. Based on any of the other examples, I bought the Microsoft stock for $10,000. My adjusted basis is $10,000. The house that I purchased for $100,000 and I had capital improvements of $50,000, my adjusted basis is $150,000. So that gets added. Realized gain or loss, it's the amount realized less the adjusted basis. Recognized gain or loss, what actually gets reported on the tax. Taxpayer issues with property transactions. Is there a realized gain or loss? Is there a recognized gain or loss? What's the character? And what's the holding period? These are the questions that come up when discussing capital gains and losses. So here we've got the calculation, gain loss realized, cash the seller received, plus the fair market value property seller received, plus debt assumed by the buyer, less selling expenses paid by seller equals the amount realized by the seller. The book has a good example of this. I'm trying to think of what it was, but it was someone buys an asset for $20,000 and then on top of that has a note payable to the seller of $60,000 and it costs $5,000 to throw this all together. That's the sale commissions. That often gets a selling expense. You see that a lot with property sales. So that would be the $30,000 plus the $60,000 for the note payable, less your $5,000. So it would have an adjusted basis of, or the amount realized of $85,000. So here we get into the tax rates for long-term capital gains. So here you can see it's 0%. That's up to 41,675 single, 83,350 married filing jointly, 15,000 if it's between this, 20% if it's here. So you can see it's much better rates. If it's 459,750, ordinary income for this individual would be in the 37% bracket. With long-term capital gains, the most they'll pay is 20. So it's a 17% difference, much better. So here we've got the determination of basis. Original basis includes cash buyer paid, fair market value of other property. In the example at the beginning, you got to give it a side-by-side and something else. That would also constitute basis. Debt created by the purchase, that is payable. Taxes paid, sales tax is a popular one. Anytime you purchase something, there's going to be some allocation of sales tax. That gets added to your basis. That is part of the cost of acquiring this property, this asset, gets added to it. Plus additions, capital improvements, that's the roof, porch. Less reductions, here you've got depreciations, distributions determined to be return of capital, gets you to your adjusted basis. I'm going to stop this video here and we will get back into it in the next one.